Good morning, everyone. I am Kelly Smith, a director in Forvis Mazars Healthcare Assurance Practice. I'm excited to have the chance today to talk with some esteemed expert panelists. As we near the end of the calendar year, we wanted to be sure to hit some hot topics that are top of mind, relevant, and timely as we get near to December 31st here. So we polled clients and industry contacts on which topics they most were interested to hear about, and happy to have pulled together some experts to cover these, and especially to then hit them with some of the most common questions we're hearing in the industry. So today's session has been broken into 3 segments. We've got a technical accounting update, a topic on ransomware and cybersecurity, which I know is top of mind and keeping folks up at night. And then our third is also extremely timely here. We're going to do an update on Washington and what to expect following the election, and how that's expected to impact healthcare providers. So with that, let's get into our first segment and introduce the first 2 panelists. So we've got Norman Mazars with us, who is a certified healthcare financial professional with more than 35 years of experience, currently a partner here at Forvis Mazars. He serves as the chair of the HFMA Principles and Practices Board and is an interested party and former chair of the AICPA Healthcare Expert Panel. We also have Brian Pavona, who is a partner here at Forvis Mazars in our assurance and advisory practice, more than 20 years of experience, and is currently a member of the AICPA's Healthcare Entities Expert Panel. He is also a fellow of the Healthcare Financial Management Association and a Region 7 executive of HFMA. So you can see on the right side of this slide here, the topics that they are planning to cover for us in the first half of our session today. I'm going to turn it over to Brian to get us started on the first topic, and then we'll see what questions we have that come up.
Well, good morning, everybody. Thanks for being here. Excited to have this chat with you today towards the end of the calendar year. We're going to jump right in with a meaty topic, and it's accounting for risk sharing arrangements and alternative payment models. And Norman, I know you've done a lot of work in this area as both the chair of the HFMA P&P board and being an interested party on the AICPA expert panel. So look forward to chatting with you about that. I think, first to level set, I think I've been hearing value-based care and risk sharing for, over 20 years in the industry. And while we're still very far from that being the way of doing business in healthcare as a majority, it is certainly further along than I've ever seen it in the 20 years. So while we've been traditionally fee-for-services, discounted fee-for-services, per diem, et cetera, we're now much more moved into bundled payments, capitation arrangements, pay-for-performance, shared savings, and risk pools. And so we thought, since there's been quite an expansion over the last 2 years on this, to revisit some of the concepts that we have to date and then think to the future. One of the ones, for example, that I think is impacting about half the country is around the TEAMS CMS program, or the Transforming Episode Accountability Model. And I think that's a perfect example of how things can be complicated in this area. Another one that I've seen quite a bit is in the area of oncology and the government working towards adding value in cancer. So, maybe I'll use that cancer example is an arrangement here to think through that you can have a traditional fee-for-service going to the healthcare provider, and then in addition having a program like the enhanced oncology services that will demand that the organization have 24/7 access to clinician for their members, navigating the plan, navigating enabling services, to help them receive the care that they need, and then doing a lot of data reporting on the back end, which then HHS and others can calculate the performance of the program for providing some up-end or potentially payback amounts. And so really what we wanted to make sure folks knew here in thinking about these risk-sharing agreements is the first and foremost is it's critical to have a thorough understanding of the program that you've entered into, and if there's arrangements to read them, paragraph by paragraph, on the screen and the boxes here are some reminders that we got to really level set first and make sure you understand where in the accounting and financial reporting models that you're going to fall. And so doing a scrub to look for derivatives and hedging accounting is really critical, as well as whether or not there are any guarantees. And so ASC 815 and ASC 460 are going to help to determine whether or not you need to consider a component of that arrangement. And I think what's really critical in this whole risk sharing alternative payment model is to remember that there could be many terms within an agreement that it could actually get you to a couple different accounting. So there could be a couple different performance obligations or terms within the arrangement. So you could have a part of a contract that qualifies for derivative or guarantee, and another one section that follows 606, or you could have an arrangement in which you've got several performance obligations, and so you've got 606, but you're applying it in sort of 3 or 4 different areas. So it's really critical to understand the arrangement, what are the performances, what are each party agreeing to. And so that's kind of a 30,000 foot level. I guess, Norman, what are you seeing in the market, and what resources are you providing your teams and your clients in this area?
Well, first of all, good morning, everyone. We appreciate you joining us today. And, Brian, really what I'm seeing more commonly is most of these end up falling, I think, under 606 or the revenue recognition standard from an accounting perspective. And I think a key thing to keep in mind this year, as I think early on, a lot of these, and the PMP board actually put out a couple of risk-sharing policies and procedure statements a while back, is in the early stages, sometimes it's difficult to estimate one way or the other. The information is not readily available. But the key concept is as more current information becomes available, particularly if it's under the control of the providers to be able to estimate, is that you do try to estimate. Are you in a gain or in a loss position? And GAAP would tell you that even if you're in a gain position, you should be recording the gains as part of these if you can readily estimate them versus just being able to say, okay, conservatively, I've had a gain multiple years. I want to just wait and record that on a cash basis. I mean, GAAP would tell you it's a plus or minus as long as that you can readily estimate what that balance is.
So just to reiterate there, Norman, this is a common question we received when we were asking polling clients and healthcare organizations. Direct question we got. I only need to record a loss on these value-based care arrangements, right?
And the answer to that is no. I mean, if you're in a positive position, and obviously materiality plays a game into these, but I think the key thing is as people have entered more and more of these is, one, the people contracting into these are communicating with your accounting department so that the accounting staff are aware of them to appropriately evaluate them. But Kelly, to your point, yes, if they had a positive gain, they really should be accruing that as well.
Not just to be conservative and only look at losses, but see what's estimable. Okay. And what's the most common risk sharing arrangement that you guys are seeing on your clients and organizations you work with?
Yeah, I think up until about a year ago, I would definitely say capitation arrangements, just right, your vanilla per member per month. But certainly now I think more than not, there are some sort of shared saving or pay per performance arrangement. Now, it's probably not as material as those other arrangements like fee for service and capitation. It may not represent a significant part of the business quite yet, but because it's newer to organizations, we end up spending, more time, with that. And I'd echo what Norman said. A lot of times we'll sit down with them and there may be an upfront cash payment received on a monthly basis, but then the upside or downside might not come for 2 or 3 years. And, typically organizations aren't entering into this unless they have really good data to project where they believe they're going to come out on it. So how does that relate to your accounting positions critical?
Awesome. Thank you both. Let's move to our next 3-letter acronym. We have value-based care. Sometimes you see that as VBC. Let's move on to ESAs. Norman, would you talk with us a little bit about ESAs?
Sure, Kelly, and this is another evolving area that I think continues to evolve, and we're seeing more and more of these in the marketplace in terms of these energy service arrangements, particularly with larger health systems. There's a group it's called Bernard Energy Infrastructure, that's out there pitching, that they can help them realize significant energy savings. And so what we've seen is these are beginning to evolve, particularly with this one organization. And these are very complex transactions if you enter into one of these. But the key concept that they're pitching here is there's a special purpose entity that's created, there's typically some type of debt issued, but the debt stays with the special purpose entity so that the provider avoids putting the debt on their books. They're also structured in a manner that the special purpose entities are not consolidated. Those are two key common concepts with this. Now, what's not common and what's interesting is when they come and they pitch these, if you have been pitched this as a provider, they'll share with you a slide that says, okay, here's the people that's implemented this, and they'll show you that people have accounted for it differently. Some people, so you have to consider in these different arrangements, you have to consider 606 revenue recognition. Is there a lease component? Is there a consideration received from a vendor under 705? And when they show that slide, they'll tell you that, okay, some people accounted for it as a lease, some people accounted it for revenue, some accounted for it as a service concession arrangement. Well, part of that is true. It has continued to evolve, but as we've peeled back the onion and really started to reach out and follow up, and even within our own firms, they'll tell you, well, we've got these within your own firm and they're accounted for differently. But what's happened is there's a multitude of complex arrangements, and they continue to evolve. So it's not like everybody's arrangement is different. So a lot of times what's driving someone accounting for it as a lease arrangement versus a revenue recognition arrangement is one arrangement truly might have a lease component and the next one is not. So the clear messaging here is if they come to you with this, is you need to make sure that you understand your particular arrangement. And a key pivotal point is there a lease component or not? Who maintains the underlying assets? Like in some of these cases, the underlying assets will retain with the provider. In other situations, they are actually leased to the special purpose entity, which can trigger the difference of accounting. Usually there's an upfront payment, a significant upfront payment. And a lot of this is kind of perceived as a services discount, if you will, that would then be amortized over the life of the arrangement. The organization Bernard is entering in here to get the exclusive right to the energy services agreement with these large health systems. And then another key component that you really need to evaluate is who gets the excess reserves. They're managing the overall energy spend, but related to those energy assets, if there are excess reserve capacity, does this organization have the right to capitalize and sell those, or do those retain with your organization? So just to be aware of all that, a common question we get to ask is, the most common question is about debt. And one thing that's consistent that we've seen with everybody adopted these is they've been structured to avoid off-balance sheet debt. The rating agencies have been intimately involved. Between the PMP board and the expert panel, we've talked to all three of the rating agencies that are out there, and they all are aware of them. So although they're not debt, they are accounting for them. So they're aware of the arrangement. It's usually set up as some sort of liability for this advance payment that's received up front. But if you have some sort of debt ratio, it's not in the debt ratio. And that's, I think, the key part of one of these arrangements. So the key thing is if you're aware of them, get prepared to get all kinds of agreements and read them thoroughly.
With that and the value-based care, right? Read every paragraph. That's what I'm hearing. And we're not skimming. We are actually reading it all. All right. With that, you should have a polling question that should have popped up on your screen. Go ahead and answer that while you've got it. But we're going to move into yet another three-letter acronym. We're going to go into ESGs, and the slides are intentionally brief here. And the reason is that this is a quickly evolving area, super interesting content, and the way that this applies to healthcare is different from area to area. So Brian, what can you tell us about ESGs and how healthcare is being impacted?
Yeah, when this was getting a lot of attention 3-4 years ago, I think in healthcare, it was pretty limited, and discussions at the board level and with the C-suite were around, well, you're already likely doing some sort of community benefits report that talks about how your organization is sort of supporting, certainly maybe some social and governance implications, whereas this continues to evolve. And so what we recommend, first of all, is that each healthcare organization have a periphery sort of overview of understanding of environmental, social, and governance implications. So while you're likely not an SEC registrant for most, it would be a good idea just to kind of understand what the SEC is requiring of those registrants, because we know it kind of trickles down. And then also, what are some state requirements or options going on? And I think, you know, the two most common, one on the East Coast, one on the West Coast. Let's talk about that a little bit. You know, in California, we've got the GHG, or greenhouse gases emission and climate risk reporting. And, you know, when that came out, it indicated that organizations that do business in California that meet a certain revenue criteria are going to have to report this. And what's interesting is when you read the guidance, it's, you know, reporting with an attest type of opinion. And so for, you know, Kelly, for you and Norman and me that are, you know, traditional CPAs more on the financial audit side, you know, we are familiar with audit reports, but there's going to be auditing that's required around the measurement and reporting of greenhouse gases. And there's a framework and a professional standard by which to do that. And so certainly if you're in California, you know, hopefully you're already thinking through what this means for you. But California is not alone. Oftentimes they'll start with an initiative that we then see in other states. But let's talk about California for a minute, or sorry, New York for a minute. So this kind of creeped up in another way, that in New York, there is a climate action premium credit program for hospitals. And this is really convoluted. The goal today is not to talk about all the specificity of it, but essentially the state of New York, through the Department of Financial Services, is offering an incentive by reducing workers' compensation claim expense if hospitals can demonstrate a program around environmental and greenhouse gases. And again, there's a framework by which to measure. The first year, you just have to attest that you're going to do commit to a plan. But if you look out to years 4 and 5 in both of these programs, there's going to be reporting requirements that then also require auditing. So I think we're now beyond just a typical community benefits report or a charity care footnote to talk about our initiatives in ESG. And it might not look exactly like it does for an SEC registrant, but how you're working with your patient populations, you know, in addition to your workforce and union activities, to kind of get to that social, the environmental with the greenhouse gases. And certainly governance is nothing new to healthcare, particularly around that not-for-profit. I think we've done a pretty decent job there of documenting how the organizations are run. So I think it's no longer NA for us, but it's not to that full-blown extent that maybe it is for industries that are heavy on environmental risk or SEC registrants, Kelly.
Sure. So this is a new and evolving area for sure. And where can accounting, finance, and leadership teams go to get the most up-to-date information so that they're sure that they're planning accordingly and complying as information does change?
Yeah, that's a great. We will share with the group. There is some Forvis ThoughtWare Foresight articles that do a really nice job, particularly around the California guidance. And then I know we've got our subject matter resources that would be happy to have a conversation about that.
Perfect. Totally worth the wait. Thank you, Brian. Our next topic, as we transition away from the ESG, is towards student financial aid and related party transactions associated with that. I do want to ask up front, this doesn't sound like a healthcare topic. Norman, who are we most commonly seeing this impact from the provider side?
Well, Kelly, you're right, exactly right. This is much bigger in the college and university space. But if you're on the provider side and you do have like schools of nursing, if you get student financial aid money, this is applicable to you. A lot of times in the big scheme of things, it's part of the process. But, you know, the new rules went into effect for any audits that are filed after July 1st of 2024. They're very cumbersome. You know, one of the things I do want to highlight about today's session is these are designed to be lightning rounds. So we're covering the A&A topics fairly quickly so that we can move through the agenda, but just encourage you on any of these topics. If you If you want more information, please follow up with one of your Forvis Mazars team members. We'll be glad to discuss it with you in more detail. The key thing here is the new rules went into effect July 1st. You know, there's supposed to be robust disclosures with your filing if you have to file an easy audit with the Department of Education, including like if you got donors, if you got board members. There's no level of materiality that was defined by the Department of Education. Another thing, the AICPA put out a TQA that said you could mark your footnote unaudited. Well, but then in October, DOE came out and said, if you mark your footnote unaudited, we're going to reject them and as part of that. But to date, you know, we haven't really heard any feedback from the Department of Education. We had a expert panel call last week, and there's been really no follow-up on the filings that have been made subsequent to July. We've heard different people, you know, the rules say you pretty much have to disclose everything. We've had some people only disclose related parties to the School of Nursing. Some people have put in a footnote and marked it unaudited. Some have kind of defined their own materiality. So the thing here is we're waiting to really figure out where the Department of Education goes with it, if it is applicable to you. And if it is applicable to you, we suggest that you file a separate report with your easy audit filing containing these disclosures, because a lot of times they include personally identifiable information, which you're not allowed to include in the clearinghouse as part of your normal single audit filing. So that's kind of the high level run through of that topic.
Moving along to ERC here, we've got the employee retention credit. So not ESG, but ERC. It's been out there kicking around since the COVID days. What is the current status of this that we need to be aware of in this stage of the game?
Yeah, so on the lightning round here, a quick update. So in November, a reprieve in that the IRS has communicated to that they're paying out, and we're seeing this resuming the refunds again on about nearly 500,000 low-risk claims that they're designating as low-risk claims. So that's nice and much-needed cash flow to some organizations. I think the key here is when we're thinking about the folks on the phone being accounting and financial reporting is to remember that, you know, even cash coming in may not reach the probability that you need for recording. So I'll give you just a quick, Kelly, a quick example to illustrate. So there's an organization who has read through the guidance 3 or 4 times, contacted a subject matter resource, and they believe that they may qualify because they had certain impacts of COVID, but it's not exactly the way ERC is listed out. So they're going to go ahead and they filled out and applied for the credit and maybe even received it back, but there's still really an uncertainty around whether or not it would hold up. And so in that situation, you got to think about whether or not you're reasonably assured that you're entitled for those funds and to keep those funds if you've already received them. And so there are organizations who in good faith applied, but aren't quite sure that they meet the criteria. And in those situations, it may be appropriate to not bring those into income until either you've gone through a period of audit and it's withstood the audit, or if there's additional guidance that comes out that, you know, indicates where they're going to be flexible on what's considered you know, part of the program. And I think it's those situations where there might not have been a strong governmental shutdown, but certainly enough governmental instructions that interrupted the business by more than that de minimis amount.
Perfect. Good 30,000-foot view there of the status. I know that a lot of organizations are also curious about when or if they may end up getting refunds that they previously requested. Do we have any updates on that front?
Yeah, you know, very little. I think that it's kind of like one-offs. So, you know, it's really just kind of stay tuned. Another one, we'll continue to put out articles as we learn, you know, more from either Washington or from our client base.
Perfect. Going over to a compliance topic here, sort of a 3-way compliance update here. We were getting questions about single audit rule changes, about PRF, OIG, and HRSA audits, and then also about FEMA duplication of benefits that people have been getting some scary letters about. So Norman, what can you tell us about the high level PRF or single audit rule changes at an overarching single audit level?
Sure, Kelly. And before I get into that, one really timely topic that we've been getting a lot of questions about is hurricane, you know, the hurricane relief. are we going to get any relief from a single audit perspective? The word that we heard last week is they do not expect anything issued from the OIG related to single audits or anything related to hurricane relief. And so the suggestion there is if you were impacted by the hurricane and it's going to be a challenge for you to meet your deadline, to reach out to your respective grantor agency and discuss that directly with them, that there's nothing blanket expected to come out. At a high level, the upcoming single audit, the UG changes that go into effect 10/1/24 for fiscal year ends that are September 30th, 2025 and later. Key thing overall is the threshold is increasing to $1 million. So some people will now fall under that threshold, won't be subject to the audit. The major program threshold for awards between $1 million and $34 million is increasing to $1 million. The indirect cost rate is increasing from 10 to 15%. So you don't have to, you can just judgmentally take 15%. A couple of other things that are out there is the equipment threshold and the supplies threshold is increasing from 5K to 10K. So you can have up to 10K and you can keep it and expense it. Same thing with supplies as part of that. And I know one of our topics coming up that's been very hot out there is cybersecurity. One of the things that everybody needs to be aware of is the new rules require you, as part of the internal control considerations, is for both the recipient and subrecipient that you're required to evaluate cybersecurity concerns. So that was one that's kind of in there that might throw some people off guard that people should be preparing for.
Awesome. Now, on the PRF front, there have been audits going around OIG, HRSA, scary words that people typically don't want to hear. What is the status of the PRF oversight and enforcement actions that we're seeing?
Well, it's ongoing. You know, across the broader community, we've seen some, like here recently in November of 2024, they released their latest report on home health and hospice. They reviewed like 30 organizations. 23 of them were found to be compliant. 7 were found to be non-compliant. In that specific niche, we also see random audits as we had various providers on the hospital and healthcare system get selected across the country. And the key thing here is just, you know, they're really focused on your lost revenue calculations. You know, if you're, which option you selected, do you have support for that, particularly if you were in option 3? And just be prepared. You know, the key thing is, are you prepared with your documentation, you know, to support that you didn't duplicate benefits, that's an excess cost, particularly with payroll allocations, is a common area sometimes that people allocate costs, but they didn't really maintain good time studies or anything to support that, is an area of focus. And lost revenue, a big issue, third-party settlements, is if they come in and they ask you for your third-party settlements, did you factor in to going back and reassessing your previous lost revenue calculations?
Awesome. And then in the bottom right-hand side of this slide, what we've got is screen grabs from letters that individuals have been receiving from HSOAC on behalf of FEMA regarding FEMA funding that had been requested, already received, et cetera. And they're now receiving letters regarding a duplication of benefits review. So, Brian, what are we seeing in this space? What should individuals do if they've received a letter such as this? What should be their first step?
Yeah, so, you know, like with any audit, you know, making sure, or review, making sure to pause and bring the folks together that were initially involved in the pandemic around all of your funding and really, you know, revisiting your case and building it out. They're really looking here for duplicate payments, but not in the sense that maybe you might think about that at the beginning, like, did we have 2 invoices being charged to FEMA? But really rather, okay, let's take these expenses that you asked for FEMA dollars and really prove out that you did not receive reimbursement from another source, including, you know, just your normal patient service revenue, business interruption insurance, grants, fundraising efforts, et cetera. And so that's really where they're focused in on. And, you know, again, just like with any review, it's pausing and really remembering how you connected all those dots throughout the pandemic to all the different sources of funding.
So I know Norman had mentioned briefly there cybersecurity as it related to single audits, but it's actually sort of a good segue into our next presenter here. So we're going to have Ben Owings join us here in just a moment. Thank you, Norman and Brian. Thank you so much. They get to pass the baton over here to Ben. You should have a polling question briefly on your screen as Ben joins us. Thanks, Ben. So Ben is a director in Forvis Mazars IT risk and compliance practice. He's been within 15 years in this space, healthcare industry and IT risk compliance and cybersecurity. Prior to joining Forvis Mazars in 2014, he spent 5 years working for a large health system supporting IT projects related to system implementations, compliance efforts, and risk management. So he is well versed in these topics. And so on this slide, we've just got major headlines here. Ben, what can you tell us about what's been going on in case anybody's been under a rock?
Yeah, thanks for having me, Kelly. Appreciate the introduction. I mean, I would say the word of the year in the healthcare industry from a cyber perspective has been disruption. I don't think that's a new term or, a new struggle that a lot of industry members are facing, but we've seen a lot of, big newsworthy headlines that have caused a lot of impact and a lot of disruption across the industry. And so I think it's important to acknowledge that, right? This is a very real threat. This is a very real impact that a lot of organizations are facing, but it's not new to the industry. And so as we look at, data coming from reputable sources like the FBI and IBM and Verizon that put out security or cybersecurity related reports and data every year, we know that for the past 14 consecutive years, the healthcare industry has been the most impacted from cyber attacks. So while we may be seeing an uptick in the way that the news is reported, we're seeing larger disruptions. It's something that's been a consistent thread across the industry.
So what do you think are the top reasons that healthcare has been such a target?
There are a lot of reasons. I'll go with three here. So I think the first is just how valuable the data is that healthcare organizations have, and certainly speaking more to, covered entity healthcare organizations, but this could be true of business associates as well. And so when you combine the kind of demographic, personally identifiable information that patients or even employees are providing to healthcare organizations, that's going to be valuable in and of itself when you're trying to push, identity theft or potential financial fraud on an actual individual using their information and, applying for credit cards or applying for loans or stealing an identity. That's very valuable information. But when you combine that with the protected health information that is not only being utilized at a large scale to put immense pressure on organizations that have had a security incident or a security breach, we're also seeing malicious actors target individuals through, blackmail and extortion attempts of, hey, if you don't pay X number of dollars, or if you don't provide this level of compensation, we're going to release your medical records on typically a social media platform of some form. We're seeing a lot of targets in this area to pediatric information because a lot of parents are going to be probably more receptive to that type of extortion or blackmail attempt if it's going to impact their children. So don't want to get away from the healthcare industry by any means, because there's certainly a lot of adolescent sensitive information there, but we're also seeing a lot of target in schools K through 12 that are being impacted for that very reason, seeking out very sensitive information about adolescents, about teenagers, and really exploiting at the individual level from that perspective. And so healthcare education from that perspective go a little bit hand in hand when we start talking about that type of information about the youth of our country, whether it be sensitive healthcare information, whether it be educational information. It really goes hand in hand from that perspective. The second piece of this is a lot of healthcare organizations have very complex technology environments and a very complex technology landscape. And so a lot of times it's hard to protect all of that. You have a lot of ancillary systems that may be used in one department of the hospital or maybe used in a rural clinic of a health system that is maybe not on the top of the priority list as maybe more of a centralized electronic health record is. And so those types of concerns certainly pose risk to organizations. The other is ancillary or antiquated technology. And so we see a lot of systems that, either through difficulty going through conversions, whether it's resource constraints, whether it's financial constraints, a lot of end-of-life systems that may be unsupported by a vendor are still being utilized within these systems, which certainly creates a lot of vulnerabilities from a cybersecurity perspective, a lot of weaknesses, and a lot of opportunities to exploit that technology. The third piece that I'll quickly touch on, and I think that's shifting a little bit from the case here, but historically, healthcare organizations have had a high propensity to pay ransoms. And so if they have been hit with a ransomware attack, they feel like in a lot of situations, the quickest and easiest way to, retain access to that information or to get their data back is to actually pay the ransom. And so that's certainly going to drive, malicious actors to continue to try to attack those organizations.
So how should organizations shift to be able to prepare for significant downtime and outages, which we have seen just hold hospitals hostage recently?
Yeah, well, I think we've got to shift a little bit from the historical view of disaster recovery, or even if we take it at a higher level, business continuity, into thinking that these are typically things that we're going to be able to recover from in a day or two, or maybe three. Right, we've seen some large disruptions this year that have taken months to recover from. And so, some of the historical, looking at a maximum allowable downtime or a recovery time objective of 0 to 4 hours, 4 to 8 hours, 8 to 12 hours is typically how we've built those out and performed a business impact analysis for a key department. We're seeing disruptions that are lasting 30 plus days. And so I think it's important for organizations, not that the expectation is that you evaluate every possible scenario, but when we're seeing, how can you circumvent a 30-day disruption, continue to provide care for patients, continue to access critical data, continue to kind of maintain operations through either workarounds or some sort of circumvention process. I think that's really important and really critical for organizations to investigate. And so you can do that through hypothetical scenarios, tabletop tests, scenario-based walkthroughs. I think is really important for organizations to consider trying to implement some sort of proactive process to prepare themselves for how would we, navigate that situation if it were to present itself at our company.
Perfect. So the more sophisticated that a health system is, the more in-house IT resources they have, the more internal or external preparation work has been done. What is the best way for an organization to assess their level of readiness and to monitor that internally from an executive level?
Yeah, I think you have to test your readiness. I think policies, procedures, plans are great. They're the foundation. They're really the design of your incident response program and process. But I'm not sure it's worth much more than the paper it's printed on, or the Word document that it's produced into an organization if you're not testing that. And so you can imagine that these are very high stress situations if you're under a security incident, certainly something like a ransomware attack. And so I think organizations practicing this and really understanding, from the highest level, this is not just an IT concern or just a cyber concern. They're certainly going to be heavily involved in, the triage and the investigation of a cyber attack or of a ransomware event. But a lot of the decisions, a lot of the communication, even something as simple as the declaration of an emergency or of a breach, are typically going to come more at the C-suite or senior leadership level. And so thinking through communication plans, thinking through response plans, and testing those, again, through a scenario-based walkthrough, which could be as simple as getting together a multidisciplinary group of leaders in a room and saying, we were just hit with a ransomware attack. What do we do now? And so walking through communication, walking through declaration, walking through how do we reach out to key resources internally, how do we contact external partners, whether that's external counsel, cyber liability insurance company, regulator, law enforcement, a managed service provider that you're working with. There's so many different layers and it's so complex that I think the more that you can try to emulate a scenario and kind of simulate what your response is going to be, the better off your organization is going to be. So it's just about proactive preparedness and not waiting until an event to kind of learn where your weaknesses are in that plan or in that process.
Absolutely. Ben, thank you so much for your expertise and bringing a sense of calm to what is such a scary and chaotic subject. We will have all of our panelists' contact information up available on the last slide. So if anybody has any specific questions on this, I know Ben would be happy to field those separately. Thank you, Ben.
Thank you.
We are going to move to our last segment here, which is a little outside the box for a CPE typically. And I'm really excited, typically only every 4 years or every 8 years. So you get something this timely maybe. So with that, I want to introduce Chad Mulvaney. He is a director in Forvis Mazars healthcare consulting practice. And he has 24 years of experience providing hospital and health system executives with insight into federal regulatory and legislative changes. So he focuses on how changes in public policy impact revenue cycle and reimbursement, as well as how value-based care models will affect health system strategies, finances, and operations. He recently joined Forvis Mazars from the California Hospital Association, where he was a vice president of federal finance policy. So can't think of anybody more prepared to speak about this topic with us. And he's going to give us some background information and then really dig into healthcare impacts. So take it away, Chad.
Well, thank you, Kelly, and good morning, everyone. It is a pleasure to be here with you. I want to take the last 15 minutes of our session to really just provide a high-level overview of how we see the election impacting providers over the next really 2 years. And granted, this is obviously an evolving situation as we look. So we will be having a detailed webinar on this in the new year, which will be an hour long and provide a little bit more information. There are really 4 things that I want to leave this group is the current administration has really looked to a very heavily regulatory approach to addressing perceived challenges with access, finance, and cost. I think we'll see the new administration look more to the quote unquote private sector and innovation to address those challenges. Now, that doesn't mean that the Federal Register is going to get smaller. It's just that they're going to be looking to a different set of actors to help solve those challenges. And very similar to the first administration, it's likely going to be more private equity-backed groups and more technology-backed groups. Second thing, I think it's important to remember that this administration is probably going to be more effective in its first 100 days than it was in the previous term. And the reason why I say that is they have more experience from the first term. And secondly, many of the people who were political appointees at CMS and within the White House have spent the last 4 years in various DC think tanks coming up with very detailed policy prescriptions that they'll be able to rip and run with right when they hit the ground. So they're going to be more effective just out of the gate. Third thing to think about, everything that was old is going to be new. And my slides keep advancing, and I'm not sure why they're doing that. So everything that's old is new. So when you think about a lot of the policies that we saw finalized in the first Trump administration that were rescinded by the Biden administration, I think you will see Trump 47 come back and very quickly reissue those. And so one example of those would be the policies that allow people to take the short-term limited duration health plans, which were finalized in the first administration to provide 12 months of coverage that could be a competitive product or a competing product for the exchange products. That was finalized first administration. The Biden administration repealed it. Obviously, the concern there is that those products only pay a couple $100s a day for hospital services, so they're inadequate coverage. I think we'll see those get rolled right back out pretty quickly. And you could see either MFAR, public charge, a whole host of other things that I think will come into play here. And the last thing to think about is I think people need to watch the governors, particularly red state governors and those red states where you've seen Medicaid expansion. And for 2 reasons. One, CMS will give states a lot more flexibility in how they manage their Medicaid programs. And so while we already see diversity in what a Medicaid program looks like with Medi-Cal in California versus Texas versus Florida versus Arkansas, we're going to see even more diversity. Governors have more flexibility to do things like implement cost sharing, different eligibility and enrollment sort of renewal processes. And then also, if they get enabling legislation from Congress, put work requirements back in. The other reason to why here in DC that there will now be an emphasis on debt and deficit, particularly in some of the upcoming legislation that we anticipate here, is that if they're focused on debt and deficit, and President Trump promised not to touch benefits for Medicare and Social Security, the last pool of dollars that's significant, that's mandatory, is Medicaid. So they'll have to do something in that space. And where the rubber's going to hit the road is what that impact looks like for state budgets. And so while it's pretty easy to talk about cutting Medicaid if you're a congressional representative or a senator in December at a cocktail party in DC, the governor's calling you up saying, hey, if you tinker with the ACA enhanced match rate, we have an automatic trip that basically that does away with our ACA Medicaid expansion. So you need to be mindful of that. And so how that plays out will bear watching. In terms of Congress, and this slide has since been updated in the packet that you'll see, but right now the House is 2 Republicans. That's an incredibly narrow margin. In the Senate, it's 47 to 53. But essentially the Republicans swept. And so what we anticipate is that they will next year, or 2 packages of legislation using a process called reconciliation, which in the Senate allows legislation to move with 51 votes instead of 60. What the House will have to do is write very specific budget instructions that instructs legislation to be written to address certain areas that impact the federal fiscal situation, and then it can be passed in the Senate. All of this, how this plays out, we're anticipating one package that focuses on energy and immigration that will move very quickly, very early. We're anticipating a second package that will be brought to the floor, or attempted to be brought to the floor later in the year, that will deal with the tax cuts, possibly the debt ceiling. And also, I would anticipate that because those 2 issues are big ticket issues, we'll have the lion's share of the healthcare related, the very specific healthcare related provisions that we care about and will impact finances and operations. Whether you can successfully move some of those bills obviously will depend on what's in it, and also, again, kind of how they impact various states and stakeholders, and also whether they'll hold kind of the Republican coalition together. And that's something that we'll unpack in greater detail in the webinar in January. In terms of the administration, as I've already sort of stated, I think they're successful. And obviously you have the appointees. We know that we have RFK Jr., who has been nominated to be the HHS secretary. We have Dr. Oz, who has been nominated to be the CMS administrator. Both require Senate confirmation. Whether or not they will be confirmed, unclear. Right now, if you made me wager money, I would bet a very small amount that both of them do. Reason why I say that is that I feel like with this administration, there are only so many quote unquote strikes, if you will, that a congressman or that a senator will be able to, or objections that a senator will be able to raise. We've already seen a fair amount of pushback on Gates, as former Congressman Gates, as Attorney General. He's now out. You obviously saw the opposition to the DEA head. That person is now out. Herskriff, although it seems like his nomination is trending more positively, has encountered some challenges, and it's not a slam dunk and may generate some opposition. Also, former Congresswoman Tulsi Gabbard for Intelligence may run into some opposition. So I think by the time we get to RFK Jr. and also to Dr. Oz, the question becomes kind of how much more ammunition do people have, or how much more stomach do they have to go against the president? Remains to be seen. In terms of what we know about RFK Jr., I believe that he will spend most of his time focusing on the FDA and also things related to public health, which will leave Dr. Oz and the political appointees at CMS to pretty much run with their agenda, and up into the point where it offends the boss's boss's boss, if you will, and something gets back to President Trump. In terms of what we know about Dr. Oz, obviously he, both when he ran for Senate in Pennsylvania and in 2020 wrote an op-ed with the former CEO of Kaiser Permanente, suggesting that Medicare Advantage for all, so keep Medicaid in place, do away with employer-sponsored insurance, the commercial market, and Medicare fee-for-service, move everybody into MA, is his preferred approach. At least it was back then, and certainly was part of his platform when he ran for Senate. I do not believe, and this is one of the few things that I am certain about in life, that you could push something like that through Congress, which would be what required. However, at CMS, he may have a fair to encourage enrollment in MA plans. So I think we will see, because of his support for MA, additional growth in MA that we may not have seen if the current administrator, if Vice President Harris had become the president under her administration. The other thing that I would suggest is worth watching is different political appointees who don't require confirmation, who will be policy assistants both to RFK Jr. and also to Dr. Oz. Again, a number of these folks have written extensively, spent time at the various Trump-aligned think tanks, whether it's Heritage Foundation through Project 2025, whether it's through Paragon Institute under Brian Blaze, or which was Linda McMahon's group. Bobby Jindal, former Governor Jindal, ran the healthcare arm of that. The folks that drafted that, I would imagine you'll see either in White House as a healthcare policy advisor or at CMS as special advisor to either the HHS secretary or the CMS administrator. And I think those are the people who will be running policy day to day, just given the fact that neither RFK Jr. nor Dr. Oz have a deep track record either in running large agencies or health policy. In terms of things that will be forcing functions where we're going to end up seeing large pieces of legislation passed, I already mentioned the Tax Cuts and Jobs Act that expires on December 31st. Also, we've got the debt ceiling that kicks back in on January 2nd. You know, the Treasury can issue no more debt, so the Treasury will have to manage payables kind of on an as-needed basis. Typically, they have flexibility to do that for a handful of months by sort of delaying payments to match when revenue comes in large dollops. You know, not an economist, didn't sleep at a Holiday Inn last night, but would anticipate that just based on historical precedent, they can probably manage that process through maybe the end of May, maybe as late as July, which means that the debt ceiling will have to be raised at some point before we hit what's known as the X date. And that to me becomes the forcing mechanism where you could see accompanying cuts to healthcare ride with that as we suddenly take this newfound concern about our current fiscal situation. In terms of what's on the table, this slide really sums up kind of different policy areas that I think are in play. And I know, Kelly, you've got some questions, so I will just turn it over to you and see what questions you have.
Absolutely. Thank you so much for distilling that very complex environment into something easily consumable there in 10 minutes. Thank you so much for that. We shopped this slide around to a couple of clients and specifically asked which of these are top of mind, most concern to you. So price transparency has been an administrative hurdle and is still a big point of confusion for healthcare consumers. So what can we expect on the price transparency front?
So on price transparency, to take a step back, at the end of last year, the House passed a bill called the More Transparency, Lower Costs Act, which included provisions codifying the existing price transparency requirements, additional penalties, some more basically instructed CMS to take a more muscular enforcement approach, and also changed some of the requirements in ways that I don't think are particularly consumer friendly. It was a bill sponsored by Congresswoman Morris Rogers, who was the chair of the House Energy and Commerce Committee. She is now retiring. The only reason that did not make it into last year's bill was that on the Senate side, Senator Schumer, the majority leader for the Democrats, certainly very friendly to hospitals, saw the flaws in this particular piece of legislation and pulled it out. There's an outside chance that we may see it in the reconciliation package. I think given that Senator Schumer is in his role, at least until the next Congress, we don't. But I do think we see something like the lower cost, the more transparency lower at some point in 2025, unfortunately.
One more question here for you. So tariffs were a core campaign platform for President-elect Trump. How should we expect these to impact American healthcare providers?
Assuming he sticks to his campaign rhetoric, that he will use tariffs as a way to bring manufacturing back into the states and also potentially as a way to raise revenue to offset extending the tax cuts in the Tax Cuts and Jobs Act, I would anticipate that we will see tariffs and goods between 10 and 20%, and for some Chinese products up to 60%. while there has been discussion that healthcare items could potentially be, still think that even if you did pull out specific categories of healthcare related products, we would still see an impact on the supply chain and supply costs, because that would even get into precursor products that are used to create products, even if they are manufactured domestically. So I don't think there's any world in which we see an increase in tariffs that eventually doesn't trickle through to our supply chains and supply costs.
Awesome. So I know there's a lot of topics on this slide that are of interest. You've got a separate webinar coming up here that you've already plugged up front. So I want to thank you, Chad, so much for your time and for covering this really interesting information that could be different from day to day. So we'll see what happens in the next webinar. Thank you so much, Chad.
Thank you, Kelly.
So one final polling question here should be up. And I do want to point out that this question is sort of at your discretion. If you have anything that we can be of help on the any of the attendees here or any other Forvis Mazars resources, please just let us know. On this slide, you've got the contact information for all of us that you've seen today on this webinar. If there's anything that we can do, please feel free to reach out to any of us and we'll connect you with the right resource. If you said yes on the last slide that you have any questions that we could follow up with you on, just be thinking on what those are, since obviously you cannot put the question in here, and we'll get you guys to the right resource. Thank you all for your time today. And thank you to all of our panelists who joined us across the span of the hour. I hope everyone has a really great afternoon. Thank you.